Okay, good morning everyone. Thank you for coming along to this session. This is Concurrent Block 6, Room E, Lifetime Income Products. My name's Nick Khalil. I'll be your chair for today's session. Pardon the voice. Today we'll be presenting two papers, not three, so can I say up front we'll have plenty of time for discussion and for questions, both after each paper and for the group discussion at the end. So please feel free to send us lots of questions via the app on these two papers that will be presented today. Before we go any further, I'd like to acknowledge all our sponsors for the conference, but in particular our platinum sponsors, RGA, Milliman and Actuaries. Very grateful to them and all our sponsors for the support that makes this fantastic Congress possible. So the session topic is lifetime income products, and for those of you not working in Australia, there's intense interest in the retirement income phase in Australia at the moment, and that's certainly not unique to Australia. That's an issue being addressed all around the world by actuaries and among others. What is perhaps a little bit different in Australia from some other places is that the solutions that are being developed need to sit on top of what is almost exclusively a defined contribution system. So it doesn't have the buttress of a defined benefit sitting under it to facilitate the development of retirement solutions, and that creates some interesting problems and challenges for solutions in the Australian market. What we're seeing today is two aspects, or what I see as two aspects of the work in this area. The first paper we're about to hear is in the design phase, so actually designing products in the retirement phase to help solve that retirement problem. The other area that actuaries work in this space, and there are many of course, and they're all related, but the other area is assessment of products. So not so much designing products, but how do you assess product suitability for given retirees or given group of retirees, whether that's sort of at a fund or trustee level or at an individual financial planning level. And the second paper we'll hear from today is an assessment framework that goes to help solving that problem. So we'll come to that one, but first let me introduce the first paper, Pooled Contingent Annuity. There's a paper on both these presentations, so I encourage you to have a look at those if you haven't already. Our speakers, we've got two speakers with us today to jointly present this. And closest to me is Vivian Deng. Vivian is strategy lead at UniSuper. And then we have Young Tan, who's investment and retirement actuary at Aware. UniSuper and Aware are two of our leading DC and DB superannuation funds in Australia. So without further delay, let me introduce Vivian first. Thank you.
Thank you. This works. Perfect. Great. Hi all, and thank you for having us, Young and I, here today for our presentation on pooled contingent annuities. So for those of you who haven't seen it, our full research paper is available on the ICA website, so happy to take any questions on that if you want to grab me or Young at any point. And today we'll briefly be going through the same structure that we have there for our research paper. So I will start with some background information, which in particular might be useful for some of those of you who aren't practicing in Australia. And I'll also then explore what we mean by this product design at a high level and why we think it offers value in the Australian market. Young will then explain in further the key design variables, what should be considered, and then he will finish off by taking one particular design approach, a straw man, and demonstrating some of our initial modelling results. And also before we start, we confirm that the work we're presenting here today reflects our own personal opinions and should not be taken to represent the views of our employers, which is UniSuper and Aware. So starting off with the Australian environment, So for those of you not aware, we have the Pillar 2 here, which is our compulsory employer contributions, which is currently at 10.5%, and it basically covers all working Australians, so it's quite wide coverage, and this will be increasing to 12% in a couple of years' time. And this started back in 1992 at 3%. So we do have this accumulation part of the system, which is maturing and growing, but as of today, we're still at the point in time where if you're retiring today, you may not have had the full SU contributions for your whole career. So there's still that heavy reliance on our means-tested social security age pension, we call it. Also, as Nick pointed out, the majority of benefits paid in Australia are now DC, not DB. Now, when members reach retirement, they can transfer their savings to what we call the retirement tax phase. So in that phase, investment earnings are all tax-free, which is great, and also there's no maximum withdrawal. So unlike other countries in Australia, you get to that phase, you can take all your money out at any point in time, whenever you want. There is a minimum drawdown rate set in the legislation, which unsurprisingly we do see many members tend to anchor themselves to. And the other recent change is that the government introduced the retirement income covenant. So every trustee has to approve and publish a summary of their retirement strategy, which sets out how they want to assist their members in retirement. And that really increased the focus of every superannuation fund on how to articulate what they are doing or what they're planning on doing in this retirement space. So taking all those things together is why we're seeing this increased focus in Australia on retirement. So this slide here sets out the retirement income strategy, the 3 requirements. I won't go into that because it's already been covered by about 3 or 4 other sessions of the conference, so all good. But as you can see, obviously, you really need to balance between the 3 objectives of high income, capital flexibility, and risk management. Just in terms of the implementation of the retirement income strategy, it's still relatively early days in Australia. So it started 1st of July 2022, which is a year. So we haven't seen much innovation in the product space or in the member servicing or advice space for most of the funds. And the dominant retirement product is the account-based pension, which is the flexible phase withdrawal type design. There have been some products launched recently or just beforehand, and our paper covers off a brief summary of those products which are in existence. But yes, the dominant fund is just in account-based pensions. So given that, that's what inspired Young and me to think about, well, how could we take what we call a pooled contingent annuity and design it in conjunction with an account-based pension. So what do we mean by a pooled contingent annuity? So to start with, if we start with a contingent deferred annuity, or CDA, so CDAs have been around in the US market since 2009, but as far as we're aware, they're still relatively unknown. So a CDA, as expected from the name, it does not pay income immediately or at a preset future date. CDA begins to pay income to the policyholder in future contingent upon 1, the policyholder is still alive, and 2, the investment account insured by the CDA reduces to 0. And clearly, given that you need to have rules around what's the regular income that can be drawn down from the investment account, and also rules around the investment strategy of the investment account. So why would this be attractive? So you can see just conceptually from the product design, a CDA would provide income to the retiree when they need it. So similar to a deferred annuity, you're providing a source of retirement income for later years. However, a deferred annuity can start payment even if the retiree has surplus funds, i.e. if investment markets are much stronger than expected. Whereas a CDA will only commence paying out income if the asset triggers also are met, which could be earlier, later, or even potentially never, depending on investment markets and of course how long the retiree will live for. Also, given the nature of the CDA, it's possible to wrap it around investment assets already provided by the provider, so the assets do not need to be managed directly and transferred to the insurer. So taking all this together, compared to other insured retirement type products, we expected the cost of a CDA to be on the lower side, as it only provides income when it's really needed. And that led us to explore, well, if you take a CDA and offer it as a pooled or internal design at a super fund in Australia, what could that be? And that's what we call a pooled contingent annuity. So within Australia, there are a couple large or what we call mega funds emerging. So for those particular funds in particular, we would expect to have enough scale to offer an internal pool of this type. And also, it can be packaged together really well with the fund's existing account-based pension product, which all funds will have. We also note that the risk management aspects of the PCA can be supported by internal reserves for the fund, and that's already consistent with how superannuation funds in Australia manage other risks. For example, it's a requirement that all super funds must hold reserves for their operational risk, for example. And clearly, given this, the PCA will be offered internally, unlike the CDA, it's not an insured benefit, so the members would be accepting that additional risk, the variability in their income. So in terms of the benefits of PCA when offered together with an account-based pension product, so as we said, most products or benefits in Australia now provided through defined contribution, not defined benefit. But that means that members are used to having investment choice over their retirement savings, particularly when they get to the retirement stage. We find that many members tend to stop and think or get advice around what should their investment strategy be or change. And most of the larger profit for member funds in Australia have an investment menu of about 15, 16 type investment options, so relatively limited. So we think the PCA can work relatively well in that environment. It can provide consistent options to the member in terms of their investment choice. In terms of an account-based pension, we know that it doesn't really offer any specific longevity or investment risk protection, other than, of course, just having to reduce the amount of drawdowns you have to manage that sustainability. And in particular in Australia, obviously, with the prevalence of members sticking to the minimum drawdown rate, which has been confirmed by other people at the conference here today, so that causes some problems. So the PCA, we think, is valuable because it can provide that protection to the member of allowing them to draw down at a higher rate than what they might be anchored to with the minimum legislative drawdowns. And also, depending on the fee or cost of how you design the PCA, members can still have the majority access to their capital of their savings should they need to. In terms of other environmental or behavioural benefits, as part of recent research carried out by funds when formulating their retirement strategies, it was clear that many members would look to their existing fund as one of their first sources of education or advice about what to do to prepare for retirement. So we think that a PCA offering as an internal type add-on would naturally work quite well with what members are already expecting their funds to be offering them. Another key theme of many retirement strategies was that the most appropriate retirement strategy is one that's personalised for that member, such as allowing for their circumstances, with their assets, held outside the fund or, their family and health circumstances. So we think that the PCA really provides that flexibility in helping members to tailor, what protection or, high income they would like. And lastly, from a behavioural perspective, members all express their key concern with that fear of running out of money, or, they wanting, peace of mind. So due to this, many members, may be dying with the majority of their retirement savings still intact. Now, why it could be deliberate bequest motive for some members, but, we think that PCA can then help directly address that fear of running out of money because it provides income when the investment account's depleted, and this can provide increased confidence and comfort to the member. And this may also allow the member to, consider their investment strategy and maybe, have a higher investment risk tolerance than they might otherwise have. Importantly, we also emphasise that, while our work here focuses on the product design of the PCA, but product design is only one component of the member offering. So any successful product change really needs to work closely with all the other aspects that the fund provides, and in this case, in particular, you would need to consider how you link it with your, advice services that the fund provides. But taking all this together, we see that the PCA offered in conjunction with an account-based pension product would be very suitable for a fund's retirement strategy, particularly in light of the 3 retirement needs and the retirement trilemma. So it can offer higher income by helping members have a higher drawdown with the extra protection. You can offer better risk management than an account-based pension product in isolation because it does offer investment and longevity protection. And it can still provide capital access depending on the cost of reserving for the PCA, which can be reasonable. Which I'll now pass to Young to talk through the design approaches in more detail.
Thanks, Vivian. So, before we talk about the PCA design, I'll quickly examine different retirement income profiles under the account-based pension for our international audience. So account-based pension offer full flexibility in terms of withdrawal options. So here we present the outcome for a starting balance of 500,000 under 2 different withdrawal strategies. On the left, we have the outcome under constant investment return scenario, and on the left, we have an outcome under adverse investment scenario. The first withdrawal strategy is what Vivian mentioned as the minimum drawdown strategy. So if you've been to Ben's session yesterday, you would understand what that looked like. So these percentages are essentially a percentage of account balance can be withdrawn, each year, and the percentages are actually set by legislation, by government, and it increase by step incrementally at different ages, which result in this distinct jagged line you can see here, which will be familiar to most Australian actuaries working in the sector. So many studies have shown that many retirees are indeed drawing down the minimum rates, although that's not by any way a recommendation of government, so that's a strong anchoring effect we're seeing in Australia. If you look at the detail of this income profile, this strategy does provide income quite steadily, but you see that income start quite low in early retirement, but it increase gradually in late retirement before it comes down really quickly after age 95. So that means the downside of this strategy is that income level is quite low in early retirement when the spending needs are likely to be quite high when people are active. And the second strategy that we want to cover today is the constant real income. So for the purpose of illustration, we will set the constant real income at 6%. So that means you always withdraw, you start at 6% of the starting balance, and for each year in the future, you adjust it by inflation, regardless of how investment experience turns out. So this strategy serves as the opposite of the minimum drawdown, because in the minimum drawdown, the amount you receive would react to the investment return, but this one doesn't. In an ideal scenario, it should last until 95, but we know that investment outcomes are uncertain. So in a bad scenario, your account can exhaust really quickly. We do acknowledge that this is unlikely how retirees would actually behave, because no one would keep withdrawing the same amount of money if they see investment market is bad. So this is mainly here to contrast the difficulty in retirees making withdrawal decisions. So you either stick to the minimum and risk spending too little, or you go with a more carefree approach to spend more, but you risk the account being depleted very quickly. So this is what we mean by the shortfall of account-based pension. That withdrawal decision is really hard for most people to make. Moving on to the next slide. So given the limitations of the ABP, we see that the PCA is a good solution to enhance retirement outcome by encouraging a safe spending rate above the minimum rates. And that's why the PCA only makes sense when it's paired with an account-based pension. The concept is quite simple. When the account is protected by the PCA, retirees are allowed to withdraw what we call the permissible income. And if the account is exhausted while the retirees are still alive, then the PCA income will kick in and provide income as long as they live. And as we see on the slide, there will be a fee charged to the account-based pension, which goes into the reserve that will fund the benefit in the future. So this is the conceptual framework of the PCA. Next, we will explore the key design elements of the PCA and their impact on cost, followed by a strawman design. So there's a few elements here. I'll go through them in sequence, but it should be noted that they are all kind of interrelated. So once you change the one variable, they will all have an impact on the fee. So let's look at the permissible income. So that's what retirees are allowed to draw down from the account-based pension each year without foregoing that protection. So this is required because otherwise, if everyone can withdraw everything from any time, then the protection wouldn't quite work. So our paper actually outlines there are different design options for the permissible income, but at the very least, we think it should offer a higher income and a better income profile than minimum drawdown to improve the outcome. The key design consideration for permissible income is the trade-off between attractiveness and cost. If we promise a high and stable level of permissible income throughout retirement, that's a very appealing value proposition, but that will increase the cost of providing the PCA protection. That's why for our strawman design, we take a balanced approach. We will start at a higher level than the minimum drawdown, so we start at 6% for a 65-year-old, and there will be ongoing adjustment subject to a hurdle rate of 6%. So that's what I mean by hurdle rate is the investment experience. So if investment experience returns 8% this year, next year we adjust the income by 2%, and if the investment experience is 4% next year, we will reduce the income by 2%. And to add some protection, we put in a floor of 70% of the starting level. So regardless of what the investment experience and the hurdle rate formula turns out to be, the floor will always be 70% of the starting level. And to keep the cost down, we also apply a ceiling of 200% of the starting level. So this can be configured and optimized subject to, depending on what the product provider is aiming to do. So moving on to the next design element, the contingent income. So how much income should the PCA reserve pay when the account is exhausted? The consideration for contingent income is quite similar to the permissible income. So the higher the income you promise, the higher the cost would be. So for the purpose of our strawman design, we simply set the contingent income to match the last annual permissible income and have it maintained at a constant nominal value for life. So there will be no subsequent variation once the contingent income kicks in. In practice, considering the pooling nature of the PCA, we advise that any provider should establish product rules in advance to allow adjustment to be made to the contingent income in the event of insufficient or low funding. It's important to note that we haven't actually considered the ongoing financial management of the PCA in our paper. That's something to be for future research. There's also the other two design elements I want to talk about quickly. So the investment strategy of the PCA reserve is quite an interesting one because of the long duration between when the fees are received and when you expect to pay the contingent income. So there's a lot of space for the product provider to optimize the investment strategy. For our purpose, we chose cash as the investment strategy, but given that long duration and the compounding interest, if you invest it more aggressively, you can potentially reduce the cost by quite significantly. And likewise, the cost of the PCA protection depends on the investment profile of the underlying account. And given most of the account-based pension in Australia use a balanced type of option as a default, so for our purpose, we just assume that a similar investment strategy for the modeling. So this is actually aligns with the goal of encouraging retirees to invest in high-growth assets, which offer higher return and a long-term income. And with the protection of the PCA, retirees should feel more comfortable to do that. And lastly, the PCA fee. So considering all the design elements we cover, the PCA fee represents the amount we charge to provide that protection. We haven't actually developed any analytical solution or sophisticated pricing model to price this, given the complexity and the interaction between investment and mortality risk. Instead, for our strawman design, we adopted a simple trial and error approach. So for now, I'll just state that the PCA fee, we expect it to be charged annually for the first 5 years, with the annual charge equal to 1% of the starting balance. Next, let's take a look at what our strawman design is expected to deliver before we talk about the funding and pricing adequacy. So this graph is an expansion of what we have presented previously. So the new bar The blue bars represents the income from PCA. The light blue bars are the one that will come from the account itself. And once the account is exhausted, the contingent income will kick in. You can see that with our design, we want to provide a front-loaded income. So this graph is in real terms, so it's adjusted by inflation. So what we want to do is to front-load income, so that incomes are higher in early retirement before allowing it to go down gradually as someone ages. So from a retiree psychological point of view, the presence of the PCA protection eliminates the stress that usually associated with when they see their account balance being exhausted quickly, knowing that something will always be there to kick in when the account balance runs out. And when we compare PCA with a constant drawdown strategy, our strawman design doesn't quite provide a constant real income, but it does eliminate the risk of running out income prematurely. We intentionally set the hurdle rate for the permissible income to gradually decline in real term, because this approach allows us to front load the income. And if you attended Ben's session yesterday, you know that many studies have shown that the real income, the income need in retirement actually goes down gradually in real terms. So there's no need for income to remain constant in real term. And this is particularly relevant in Australia, where age pension, our first pillar, is quite generous, and it keep pace with average wage growth. So from a retiree's point of view, the combined income from this product and age pension should allow the total income to be relatively stable well into advanced ages. So having demonstrated what a PCA can deliver, let's turn our attention to assessing the funding and pricing adequacy. So in this slide, we explain the approach we use to test the pricing adequacy of our strawman design. For simplicity, we conducted a stochastic funding assessment for a closed group of 1,000 retirees of the same age. And then we simulate the age of death for each of them. And then we project their balance and permissible income based on 500 stochastic investment scenarios. And then we were able to determine if and when contingent income would come into effect for each retiree and how long this income need to last. So this approach allows us to calculate the funded ratio for each investment scenarios. The defined benefit actuaries in the audience should find the concept of funded ratio quite similar to how DB funds are assessed, because it represents the ratio of the present value of the fees to the present value of the total projected contingent income. And we also wanted to note that our closed group assessment tend to exhibit more extreme outcome and volatilities compared to an open-ended group type of assessment, because the lack of ongoing new entrants. And the closed group assessment doesn't benefit from the long-term time diversification on investment return experience, so there's some element of conservatism in our funding adequacy assessment. So let's look at the result of our stochastic testing. So this table illustrates the distribution of funded ratio over 500 investment scenarios. So only 7 out of 500 simulations resulted in a funded ratio less than 100%. Sorry, let's just go back. And in most scenarios, which is around 98% of the investment simulation, it results in a funding ratio over 100%. And actually, there's actually a big chunk of simulation that results in a really high funding ratio. So this sort of highlights the conservatism nature of our strawman design, and there are definitely room for refining the parameters to provide a better outcome. For the purpose of our paper, we haven't explored and refined our strawman design further. We did, however, change the permissible income floor and ceiling from 70 to 80%. So to make the product more attractive, and we can see that even with this improvement, there's still a good chance of being well-funded under this design. So to summarize, we believe PCA can be an effective solution for countries with a dominant DC system, where lifetime income products are either lacking or unpopular. And in Australia, a properly designed and tested PCA can be a valuable low-cost add-on to the account-based pension, which are already offered by most funds. As Vivian explained earlier in the presentation, there are other behavioral benefits that a PCA can provide that I won't iterate here. And finally, we just want to emphasize that what we presented today as a strawman is only an initial design. Under the design framework, you can actually come up with multiple solutions. Our intention is to stimulate new thinking and research in the area of retirement income, so it's not always about a choice between lifetime annuity and account-based pension. And there's a short list of topics for further research that we encourage UNSW or other university with actuarial school to investigate further. And that concludes our presentation. Thanks for listening.
Thanks. Thanks very much, Vivian and Young. Please put your questions through on the app. I don't have any coming through at the moment. I trust it's working, but please put them through. We'll wait for a microphone, I think, if we're getting them from the floor. So just bear with us. Please, either the microphone or the app for any questions we have. We have another one here next. So here first, sorry, yep. Just state your name, please.
Peter Devlin. Just wondering, is the annuity you're modelling, is that a single life or is it a single life with a contingent pension? And the second question is, you took 500,000 and you converted it to 30,000 pension real, yeah? Which is an annuity of 16.7, which I thought was quite low, given there were 65. I was wondering, is that, what sort of, why is it so low compared to what my sort of thoughts would be, where it's, if you're in Germany, for instance, it would be much higher?
You can answer.
Okay, so it's single rate in our modeling, so we even allow for couple. And the other question around annuity rates, I think the rates in Australia are actually much lower.
Yeah, I mean,
if I recall.
my phone's not working, but like my colleague just sent this morning, I think it's 12 or 13 type rates. So 16 would be higher. Obviously depends on the requirements and, the local regulations and things like that.
Do you mean the other way around? Because the annuity factor is the cost.
I can't remember. Pete sent me something.
Usually, I think the last time I checked is around 4% to 5% offered by annuity.
Oh, yeah, that's what you mean. Yeah.
And we also, annuity doesn't allow retirees to have the access to lump sum, whereas this product, if at any point in time investment returns turns out to be really good, you can actually withdraw more, or you can even exit the product by foregoing that protection. So you always have that lump sum access. So this is a trade-off.
Hi, Nikhil here. Nikhil Shah from McGing Advisor and Actuarial. Thank you, and appreciate the sort of leadership which we need here. But if we just a couple of questions. This looks like it's quite complicated and hard to understand, but it's some sort of investment guarantee as well. And if we go back to your 7 in 500 scenarios where, less than 100% funded, that's 1 in 15 years, which is quite quite challenging. And I saw on slide 12 where you had your bad investment scenario that actually taking the minimum drawdown in most years would actually be a bit better than this approach up till age 95, which by that time I'll have kicked the bucket anyway. So the challenge is that trying to convey this and understand it, what are the benefits really? And I struggle to see that through that graph in the bad scenario, and I struggle with graphs anyway. Anything in 2D with multiple lines is hard to understand. And secondly, pooling, it's investments. If investments go down, you've got 1,000 pensioners, it's all going to happen at once. So all kick in at once. And I guess not a question for you, as an industry, is this an insurance challenge? Having reserves, they're either going to kick in or they're not. And 1 in 15 years is quite a high probability of ruin, and that's when it will be required to kick in as a contingent annuity. So it'd be good to hear your thoughts, and maybe other people in the room chime in how to solve the problem.
You want to go back to the slide?
Yeah. Is that the... Oh, it's on our screen, but not on that screen.
Oh, okay.
Just while Young's getting it up. One thing is the income in the earlier years is higher, so you're drawing down more at the start, which depletes your account balance as well. So it's providing a different, income pattern compared to the minimum drawdown, which fits in line with say the A&P session yesterday as well, and what we expect retirees to want. So it is providing a high income at the start, which is when we expect retirees to want it. So that's one of the key benefits. In terms of the funding situation, it obviously depends on your cohort and your membership. But one of the things with the PCA is given the long duration, and obviously it's, if you're having new members entering at all points in time, you're not going to have a situation where every single member with the PCA protection is going to need it at any point in time. Because you have members paying the premium, it's only 20 years later that you're likely to be paying benefits to those members. So you should get a really nice diversification spread across the members within your fund or product who would need the protection. So I don't think we'd be too worried about that. And the other thing as well, because it's not a guaranteed product, but it's an internal pool, if an adjustment is needed, the benefit doesn't go to zero. You can reduce the amount of benefit being paid out. Which is also consistent with, say, if you have like a CDC scheme in a different country or something like that. So there's a lot of flexibility that we can offer to mitigate that. Anything else you want to add?
The only thing I would add is because although we have done the modeling and results in a closed pool of membership, but we expect the product will work best if we can keep it open and receive new member at the time. So that actually make the cost even cheaper because, as Vivian already mentioned, we're not expecting investment outcome affecting all cohorts, but it should affect different cohorts, as many studies have shown. It's the time you retire that provide that uncertainty around the chance of your account balance, experiencing that bad investment sequence. So the more cohort you bring in, the more diversification you will get. But there need to be an acknowledgement of the reserve is set up to benefit multiple generations, so it's not. You may be contributing to future generations when the investment outcome is bad for their cohort.
Many thanks for the very interesting talk, Stefan Grass, my name. You just answered basically one question that I had. When one of these bad scenarios actually kicks in, you were to, at the very end of the day, reduce the benefit payments to your members, right? If I understood that correctly. Okay, this is so different compared to I would say European thinking, because you would not just decrease your withdrawals because your lifelong spending needs, they wouldn't decrease as well. So you will have kind of a funding gap. The question I was wondering to ask, if I understood that correctly, the analysis you did here assume a Sharpe ratio of something around 1, so the expected return being 7.5 and the standard deviation being 8. At least in my point of view, a Sharpe ratio of 1 is not overly pessimistic. So I was wondering if you do have some sensitivity analysis in your paper which outlines a, say, bad assumption, different capital market assumptions, and how do these numbers compare when you look at the more, say, I would say, not too good asset investment scenario, actually. Thank you.
Do the Sharpe ratio.
I'll Sharp ratio. So the cost that we presented here is specific to that investment characteristic. So if we do allow flexible choice in different risk and return profile, that would affect the cost, but we haven't actually done that sensitivity analysis in our paper yet. What's the other question?
In terms of the drawdown, yeah, it's a good point, and obviously in Australia, because it is a DC environment, not annuitization. So you do find that yes, members have to reduce their drawdown, but interestingly, so we had the COVID impact, and one of the things the Australian government always does is when there's a big financial fall, the minimum drawdown that you have to take out of your retirement savings actually change the rates. So instead of 5%, they cut it down to 2.5%. So you found that you had a lot of members taking even less money out of their retirement savings, not just because the market went down, but because the government said, oh, you can leave it in there. So we had even less pension drawdowns. So yeah, the Australian context is very different to some of the European countries. Members are very used to, I guess, having to take the hit of investment markets and being flexible around their drawdowns.
I'll just clear a couple from the app, and there's a couple more from the floor as well. Keep them coming. Do your stochastic funding ratio results imply a need to hold 30% of account balances as risk capital in a 1 in 200 economic capital framework? So that's from Duncan. Duncan, do you want to clarify where you got the 30% from?
That distribution that's on the screen, so the top two rows on the right, 0.4 plus 0.2, 0.5% of outcomes, roughly, are deliver a funding ratio of under 70%. So I'm just, maybe this is incorrect, but I'm saying, well, does that mean 70% equates to 30% risk capital if I only get a poor funding ratio of that's that poor in 0.5% of my scenarios? I'm in a 1 in 200 economic capital framework. My point is that even if you're not guaranteeing, if there's not an insurer guaranteeing the payoff, you're trying to deliver a solution to members, how certain as a provider do you want that solution to deliver for your members? Would you still have an economic capital mindset around how you think about the delivery of your promise, even if you don't have a kind of formal regulatory capital requirement hanging over your head? So that's the 30% is kind of the inverse of that 70% threshold on the funding ratio. And maybe my maths is wrong, but that was the logic.
Yeah, I mean, I don't think, depending on the fund, I know for a lot of retail funds, for example, like, the large retails, they probably would generally have that kind of reg capital type framework. Typically with the industry funds in Australia, that wouldn't be, I don't think they'd be deliberately wouldn't be promising that level of protection, and therefore wouldn't be thinking about it from that level of like reg or economic capital. So I think it depends on how you're offering to the members and what's expected. But you definitely would get some funds where it's not required, but they would be thinking from that level of reg cap.
Sorry, can I just clarify then? The funding ratio that you're doing here, I inferred from the earlier slides that if in a bad scenario where you cut the payout, that the funding ratio, that's allowed for in the way you're calculating these funding ratios. Are these determined against just a constant payout regardless, or are you factoring in the kind of, if you like, the action to vary income in the calculation of the funding ratio?
So the funding ratios here allow for the variation in income subject to the floor.
That's what I assumed. Yeah, okay. Thank you.
Okay, Ben.
Thanks, gents. Great analysis and some really interesting food for thought. Do I take it correctly that we're pairing an account-based pension, which I really like, having something that's familiar, but we're also making basically, I mean, it's a straw man, I get that, but the assumptions are based on you're not using the flexibility of the account-based pension. We're just drawing out of the maximum permissible, not exercising investment choice, not exercising lump sum access. And so I assume if you exercise those choices, we'd have to either adjust the fee or the residual payments from the contingent portion. So yeah, I'm wondering, yeah, where do you go from there? Do you sort of go in one direction and say, well, let's just actually assume that they don't exercise those, and then you can just put a wrap around the whole thing, and you almost have just a GSA, and it's a very structured, all-in-one solution that could be really quite simple, or you take it the other direction and allow all the flexibility, but you'd have to have probably several layers and dimensions of complexity. Just interested in your thoughts.
Yeah, I'll go first. My personal preference was that you allow that flexibility. I know in particular for some industry funds or advice models, they typically have say 5 standard advice portfolios, which obviously is already a balance itself across the investment menu. So I don't think you'd want to take this and have it as a very fixed, end up as a fixed GSA design. You'd want it to allow for flexibility. So depending on members' risk tolerance, which can change over time, then they can have that flexibility. Yeah, and that's obviously the benefit of that design.
Yeah, I think I would agree with that, because the key idea of having that account-based pension familiarity is the possibility of having access to lump sum, or even though we set the permissible income, but you can actually withdraw that. You can design a product to allow withdrawal above the permissible income, but that would just proportionally reduce the protection later. So there's a lot of flexibility we can play with around it.
Sorry. Yep.
I'm Paul Swinhoe. The way I look at it, the rocket fuel that drives annuities is the amount that you take off the people who die young and give to the people who die old. On the graph that you had up there, you didn't start drawing on your reserve until age 95. I'd kind of like to see the reserve being drawn on from about life expectancy. And I wondered what your comments were on increasing that 1% fee to 2, 3, 4%. And as a result, getting better incomes throughout everybody's lifetime.
Did you want to do it? You want to think first? Yeah. No, definitely. I think for the purpose of the straw man to start with, we wanted to, I guess, see, how low we could make the fee and what could be provided. But, definitely, depending on, I think, the membership and what the expectation is of the particular fund, demographic, yes, you could have a higher fee and then have, high income and therefore obviously draw down faster and therefore have the, the PCA kick in earlier. There's definitely a lot of, uplift or optimization you could think about. But to start with, we were trying to see, well, we assumed the PCA would be quite cheap, so we're trying to see how cheap we could get it, which, Young started with the 1% for 5 years. But no, definitely, if you wanted a higher fee and members were happy to pay a higher fee, which in the Australian context is a bit debatable, then yes, you could have a high income.
Hi, thank you. Jules Gribble here. Two comments. One is, I think it's probably worth just pointing out that there's a fundamental difference between this approach and the traditional approach, which is we take out the guarantee on the annuity. And the benefit of doing that is you get lots of flexibility. And this is saying that from a practical point of view, not formally, but pragmatically with a 0.5% under 70%, you're pretty likely to get there anyway. So it's a sort of market guarantee, not a formal guarantee. But the concept of taking the guarantee out is an important distinction. That's the first point. And the second point is I assume that in your PCA reserve that you're getting a mortality dividend in effect as you go through it. So as people die, they leave their contributions in there. I'm just curious to ask if you have a sense of how big that mortality dividend is. So, for example, is it equivalent to getting plus, I don't know, make it up, 3% on your otherwise investment return or not? Because that would be an important driver, not only for how big it could be, but also how you might invest it, because you might then invest it more conservatively for, confidence and all that sort of stuff.
I think you didn't quantify it, did you, the breakdown? I think it'd be quite large, so particularly because under the straw man, it doesn't kick in till age 95. So I'd expect the mortality dividend to be quite high. The other thing, and similar to Ben's question, who's gone, but we haven't allowed for lapse experience at all. So obviously, like Young was saying, the more lapse experience you get, that actually increases the funding ratio because you have less protection required for the members left in the pool. So there is a fair bit of surplus that you could have depending on the member experience, not just mortality, but lapse as well.
That's particularly relevant because we are charging the fee very early, so we're only charging a fee in the first 5 years. So I don't think it'd be that sensitive to mortality experience.
No, the sensitivity probably isn't quite. Yeah, the volatility wouldn't be high, but amount of credit would be quite large. Yeah.
Hello, Eric Granson.
Okay, we'll make this the last one from the floor for the moment. Thanks.
Thanks. Yeah, I apologise if I missed out on the asset allocation, but I was just wondering if you added some inflation indexed assets that were pretty secure, whether you could kind of improve the downside part of the equation.
Are you referring to how we invest the PCA reserve?
Yes.
I think that's definitely something that we haven't explored in detail, but you can potentially reduce the cost by quite significantly given that long duration between you receive the fee and when you have to pay out.
Great discussion. There's certainly more questions on the app and there may be more on the floor. So could I ask you just to keep those in your mind, because we will come back to the group discussion at the end and hopefully have time for them. But can we now just thank Young and Vivian for their paper and presentation.